2. Heads of research at all Federal Reserve banks. Enclosed for distribution to respondents is a national summary of the January 2023 Senior Loan Officer Opinion Survey on bank lending practices. For release at 2 p.m. Eastern Standard Time. February 6, 2023. The January 2023 Senior Loan Officer Opinion Survey, SLOOS, on bank lending practices addressed changes in the standards and terms on, and demand for, bank loans to businesses and households over the past 3 months, which generally correspond to the fourth quarter of 2022. 1. Regarding loans to businesses, survey respondents on balance reported tighter standards and weaker demand for commercial and industrial, C&I, loans to large, middle market, and small firms over the fourth quarter. 2. Meanwhile, banks reported tighter standards and weaker demand for all commercial real estate, CRE, loan categories. For loans to households, banks reported that lending standards tightened or remained basically unchanged across all categories of residential real estate, RRE, loans, and demand for these loans weakened. In addition, banks reported tighter standards and weaker demand for home equity lines of credit, HELOCs. Standards tightened and demand weakened, on balance, for credit card, auto, and other consumer loans. The January SLOOS survey also included a set of special questions inquiring about banks' expectations for changes in lending standards, borrower demand, and loan performance over 2023. Banks, on balance, reported expecting lending standards to tighten, demand to weaken, and loan quality to deteriorate across all loan types. Lending to businesses. Table 1, questions 1 to 12. Table 2, questions 1 to 8. Questions on commercial and industrial lending. Over the fourth quarter, significant net shares of banks reported having tightened standards on C&I loans to firms of all sizes. 3. Banks also reported having tightened all queried terms on C&I loans to firms of all sizes over the fourth quarter. 4. Tightening was most widely reported for premiums charged on riskier loans, spreads of loan rates over the cost of funds, and costs of credit lines. In addition, significant net shares of banks reported having tightened loan covenants and collateralization requirements to firms of all sizes. Moderate net shares of banks reported having tightened the maximum size of credit lines to firms of all sizes. Tightening of the maximum maturity of loans or credit lines was reported by a significant net share of banks for large and middle market firms, while a moderate net share reported this term for small firms. 5. Similarly, a significant net share of foreign banks reported having tightened standards for C&I loans over the fourth quarter. Major net shares of banks that reported having tightened standards or terms on C&I loans cited a less favorable or more uncertain economic outlook, a reduced tolerance for risk, and the worsening of industry-specific problems as important reasons for doing so. Significant net shares of banks also cited decreased liquidity in the secondary market for C&I loans, less aggressive competition from other banks or non-bank lenders, deterioration in their current or expected liquidity position, and increased concerns about the effects of legislative changes, supervisory actions, or changes in accounting standards as important reasons for tightening lending standards and terms. Regarding demand for C&I loans over the fourth quarter, significant net shares of banks reported weaker demand for loans from firms of all sizes. Further, a significant net share of banks reported a decrease in the number of inquiries from potential borrowers regarding the availability and terms of new credit lines or increases in existing lines. Similarly, a significant net share of foreign banks reported weaker demand for C&I loans over the fourth quarter. Of the banks reporting weaker demand for C&I loans, major net shares cited decreased customer investment in plant or equipment, as well as decreased financing needs for mergers or acquisitions, inventories, and accounts receivable as important reasons for the weaker loan demand. 6. Questions on commercial real estate lending. Over the fourth quarter, major net shares of banks reported tightening standards for all types of CRE loans. Meanwhile, major net shares of banks reported weaker demand for loans secured by non-farm non-residential properties and construction and land development loans, and a significant net share of banks reported weaker demand for loans secured by multifamily properties. A moderate net share of foreign banks reported tighter standards for CRE loans, while a modest net share of foreign banks reported weaker demand for such loans. Lending to households. Table 1, questions 13 to 26. Questions on residential real estate lending. Over the fourth quarter, lending standards tightened or remained basically unchanged across all RRE loan types and for HELOCs. 7. Moderate net shares of banks reported tightening standards for jumbo and subprime residential mortgages, while modest net shares reported tighter standards on HELOCs, qualified mortgage, QM. Non-jumbo non-government-sponsored enterprise, GSE, eligible mortgages, and non-QM non-jumbo mortgages. In contrast, standards remained basically unchanged for GSE eligible and government residential mortgages. Meanwhile, major net shares of banks reported weaker demand for all RRE loans over the fourth quarter, except for HELOCs, for which a significant net share of banks reported weaker demand. Questions on consumer lending. Over the fourth quarter, a significant net share of banks reported tightening lending standards for credit card loans, while moderate net shares of banks reported tighter standards for auto and other consumer loans. Banks also reported tightening most queried terms on credit card loans. Specifically, moderate net shares of banks reported higher minimum credit score requirements as well as tightening both credit limits and the extent to which loans are granted to some customers that do not meet credit scoring thresholds. Similarly, banks reported tightening most queried terms on auto loans, on net. In particular, a moderate net share of banks reported wider interest rate spreads on such loans, while modest net shares reported higher minimum repayments and higher minimum credit score requirements. For other consumer loans, modest net shares of banks reported widening spreads over the cost of funds, increasing the minimum required credit score, and tightening the extent to which loans are granted to borrowers not meeting credit score criteria. The remaining terms and conditions for each type of consumer loan remained basically unchanged. 8. Regarding demand for consumer loans, significant net shares of banks reported weaker demand for auto and other consumer loans, while a moderate net share of banks reported weaker demand for credit card loans. Special questions on banks' outlook for 2023. Table 1, questions 27 to 40. Table 2, questions 9 to 16. The January SLOOS survey also included a set of special questions inquiring about banks' expectations for changes in lending standards, borrower demand, and asset quality over 2023, assuming that economic activity evolves in line with consensus forecasts. 9. On balance, banks reported expecting lending standards to tighten and loan demand to weaken. Meanwhile, banks reported expectations of a broad deterioration in loan quality during 2023. Regarding lending standards, major net shares of banks expected to tighten standards for C&I loans to firms of all sizes and for all types of CRE loans over 2023. Meanwhile, significant net shares of banks also reported expecting to tighten standards for non-conforming jumbo mortgage loans, credit card loans, and auto loans. 10. A moderate net share of banks also reported expecting to tighten standards on GSE-eligible residential mortgage loans. The most frequently cited reasons for expecting to tighten standards over 2023, reported by major net shares of banks, included an expected deterioration in collateral values, a reduction in risk tolerance, and a deterioration in credit quality of the bank's loan portfolio. Meanwhile, major net shares of banks reported expecting loan demand to weaken across CRE and RRE loan categories over 2023, while significant net shares of banks reported expecting loan demand to weaken for C&I loans to firms of all sizes and auto loans. A moderate net share of banks expected demand for credit cards to weaken. The most frequently cited reasons for weaker loan demand over 2023, reported by major net shares of banks, included an expected increase in interest rates, expected lower spending or investment needs, an expected deterioration in terms other than interest rates, an expected easing in supply chain disruptions, and an expected decrease in precautionary demand for cash and liquidity. Regarding expectations for credit quality, as measured by delinquencies and charge-offs, Major or significant net shares of banks reported expecting a deterioration in credit quality across all loan types over 2023. 11. Specifically, major net shares of banks reported expecting credit quality to deteriorate for C&I loans to small firms, syndicated leveraged and non-syndicated C&I loans to large and middle market firms, non-farm non-residential and construction and land development CRE loans, consumer loans to non-prime borrowers, and RRE loans. Additionally, significant net shares of banks reported expecting loan quality to deteriorate for consumer loans to prime borrowers, syndicated non-leveraged C&I loans to large and middle market firms, and CRE loans secured by multifamily properties. Regarding foreign banks, significant net shares of such banks reported expecting tighter standards for all C&I and CRE loans over 2023. In addition, foreign banks also reported expecting weaker or basically unchanged demand and a broad deterioration in the quality of C&I and CRE loans during 2023. This document was prepared by Luke Morgan, with the assistance of Ria Sanawane, Division of Monetary Affairs, Board of Governors of the Federal Reserve System. Measures of supply and demand for commercial and industrial loans, by size of firms seeking loan. Chart 1. Net percent of domestic respondents tightening standards for commercial and industrial loans. Chart 2. Net percent of domestic respondents increasing spreads of loan rates over banks' cost of funds. Chart 3. Net percent of domestic respondents reporting stronger demand for commercial and industrial loans. Measures of supply and demand for commercial real estate loans. Chart 1. Net percent of domestic respondents tightening standards for commercial real estate loans. Chart 2. Net percent of domestic respondents reporting stronger demand for commercial real estate loans. Measures of supply and demand for residential mortgage loans. Chart 1. Net percent of domestic respondents tightening standards for residential mortgage loans. Chart 2. Net percent of domestic respondents reporting stronger demand for residential mortgage loans. Measures of supply and demand for consumer loans. Chart 1. Net percent of domestic respondents tightening standards for consumer loans. Chart 2. Net percent of domestic respondents reporting increased willingness to make consumer installment loans. Chart 3. Net percent of domestic respondents reporting stronger demand for consumer loans.